bachelor's degree in business administration from the University of Western Ontario, and also has a chartered financial analyst designation. In 2012, she received the Diamond Jubilee Medal as a builder and an innovator in Canada's investment industry. Please help me give a warm welcome to Ms. Lynn Patterson.
Well, thank you, Linus, for that kind introduction. And good afternoon, everyone. It's my absolute pleasure to be in Calgary today and to be speaking to the CFA Society. And I'm going to assume, as CFAs, that some of you are involved in markets and are likely experiencing how quickly technology and markets are evolving. Given my background that you just heard about, I can relate. The changes that I saw during my years in fixed income and equity markets were remarkable. Now, shortly before I began in the markets, if you wanted to sell a bond, you would pick up the phone and call somebody, and after you had done your transaction, you'd do all the teletype details into a machine, and then someone in your back office would actually physically descend into the vault to pull that security and then deliver it by hand to the buyer. Well, just imagine how cumbersome that process would seem to today's traders that are used to selling and trading millions of dollars of securities with a couple of taps on the keyboard. The shifts in market function and participation that we are seeing globally today are as dramatic. Some stem from central bank actions in certain jurisdictions, such as quantitative easing and negative interest rates. Others are the result of regulatory reform, new technologies, and investor preferences. Think, for example, of the influx of investors in the commodity space using indexed or exchange-traded funds, or how high-frequency trading firms, called HFTs, are compressing bid-ask spreads in futures and equity markets, or the development in Canada and abroad for central clearing counterparties, and for over-the-counter derivatives and repos. So keeping up to date with new trading practices and how the markets are functioning is really important to us at the bank. Our mandate is to promote the economic and financial welfare of Canada. So we closely monitor the vigor and health of the system. My responsibilities at the bank include the oversight of our activities in financial markets, and that includes market intelligence, which is my topic today. Now, market intelligence can take many different forms, including in its broadest sense, the macroeconomic insights that we gained from talking face-to-face with businesses that are operating in the real economy. This includes the important work that's done by our regional teams on a quarterly basis for the Business Outlook Survey. I can't emphasize enough how critical these real-time perspectives are to our overall understanding of economic developments, and this is especially true during periods of heightened uncertainty. They provide us with timely insights that we wouldn't otherwise have been able to see in the data until much later. Now, in my remarks, I will highlight an example of how this feeds into our policy decision-making, but my focus today will primarily be on the intelligence that we gather from financial markets. Let me start by expanding on the significance of the bank's market intelligence. I will then explain how we gather it and how that has evolved, and finally, I'll share with you what we're learning and how we use what we learn. The market intelligence that we gather is a critical complement to our analytical work. Often, in interpreting data or through our modeling, we develop a view about the future of the economy or inflation, and our intelligence work then offers us an opportunity to corroborate or potentially refute what we're seeing in the data. It helps us fill in those pieces of the puzzle that are missing or that need greater clarity, so that we can refine our judgment surrounding the outlook. All of this helps us shape bank policies and is integral to our core functions. So let me just say a few words about those core functions. First is the conduct of our inflation-targeting monetary policy. We have successfully maintained inflation close to our 2% target since 1995. The policy's effectiveness depends on the efficient transmission of our rate decisions through to capital markets. It's therefore essential that we have a solid understanding of how those transmission channels function and are evolving. Second, we act as fiscal agent for the federal government. We manage the reserves, auction their bonds, and manage the cash. That's why it's important for us to assess how market developments could influence these activities. And third, we're responsible for promoting the efficiency and stability of the financial system, and we do this in a number of ways. We consider financial stability issues in our decisions and our operations. We provide liquidity facilities and serve as lender of last resort. And we oversee key payment, clearing, and settlement systems that support the Canadian economy and financial markets. So we need to understand how market developments could affect the financial system, its vulnerabilities, or the effectiveness of our tools. Now, I should underline that payment and settlement systems aside, we do not have regulatory responsibilities for financial market participants. This is actually helpful and conducive to an open, two-way exchange of views. At the same time, we do maintain a regular and open dialogue with federal and provincial authorities that do exercise such responsibilities. And we share with them our analysis of potential vulnerabilities and risks. Now, gathering intelligence isn't new for us. The bank has been observing markets since it opened in 1935. However, until the 07-09 financial crisis, intelligence gathering by central banks, including the Bank of Canada, tended to focus on operations and monetary policy formulation. But the crisis made it clear that central banks missed some areas where risk was building. We were familiar with traditional markets like government bonds and foreign exchange, but much less knowledgeable about some other areas, such as markets for structured credit or over-the-counter derivatives. And these were some of the areas where leverage had risen to dangerous levels. In 2009, the G20 called for new regulations to strengthen the stability of the global financial system. The measures that have since been put in place range from structural reforms to capital enhancements. They include new solvency and liquidity standards, and new risk requirements for products such as over-the-counter derivatives. Today, the institutions at the heart of the system, the bank and other financial intermediaries, are safer and have lower levels of leverage. However, we all know that risk remains. It may now reside in some areas that are not subject to as much or any regulation, and as such is not easily observed. Now, the regulations have also affected that intermediary function that the banks have long performed. As they look to optimize their use of capital, they're allocating less balance sheet to certain asset classes, such as corporate bonds. This has affected liquidity in these products and altered the way that investors execute and trade. In response to these evolutions in market functioning and behavior, we have adapted how we track the health of the system. We've increased the frequency of our checkups. We're making contact with a broader set of players, and we've added new diagnostic tools. We now devote more resources to the who, what, how, and why of the vulnerabilities that we identify and their interplay with markets. So how do we gather market intelligence? Well, to undertake these new tasks, we've expanded our team at the Bank of Canada because communication is key. Not by email or tweets, but in-person meetings and discussions with a wide range of market participants. We augment our conversations with analysis, research, and surveys. Now, to facilitate our exchanges, we maintain and in some cases have augmented our presence in Toronto, Montreal, and New York. We also make regular visits across the rest of the country, as well as to London and other key financial centers. Across Canada and around the world, we also hear from participants at our speaking engagements. And while we're committed to communicating new information on the outlook and policy only in public settings, the insights that we garner in all of our sessions are invaluable for our policy making. Internationally, we collaborate closely with other central banks by participating in global survey work and by sitting on committees of various global institutions. Another important source of intelligence for us, and one that helps us understand developments in foreign bond markets, is our reserve management operations, which total roughly $75 billion in assets denominated in foreign currencies. Domestically, our own operations are an important source of intelligence on funding and liquidity. Our traders maintain a continuous dialogue with participants in our receiver general auctions and our repo operations. We combine what they learn with our sources of market intelligence in a framework that we developed a couple of years ago to assess financial system vulnerabilities and risks. And some of you, if you're familiar at all with the Financial System Review, may be familiar with this framework. We just published our last Financial System Review a couple of weeks ago. So this framework helps us explicitly identify underlying weaknesses such as high leverage, asset price misalignments, or maturity and funding mismatches that could amplify and propagate shocks. For example, a few years ago, we increased our focus on ETFs, and particularly those related to fixed income instruments, given their increasing popularity with investors. Now, while ETFs are still relatively small in Canada, if they were to grow substantially, they could propagate liquidity shocks, especially where the underlying assets that they hold are less liquid. We have no concerns about the sector at the moment, but we will continue to monitor its functioning and growth. With the expansion of our intelligence gathering, we have developed a wider network of contacts. Still, we know the financial sector is dynamic, and our work will never cover all of the playing field. Nonetheless, we capture a broader sweep of market segments and participants, and this allows us to gather information when significant events that could affect Canadian markets occur, such as the commodity price collapse, Brexit, or the most recent U.S. election. The expansion helps us track more closely how markets are positioned going into such events, gauge how they will react, and, in the aftermath, understand the short or the long-term repercussions. So let me get to that example that underscores why multiple sources of broader intelligence are so helpful for us, particularly at times when there is a great deal of uncertainty in markets. You may remember that in the months following the commodity price collapse in 2014, the outlook for oil prices was cloudy. The futures curve out to 6 months was upward sloping, and that was implying that either market participants were expecting oil prices to rebound, or more negatively, that the cost of storage was increasing due to higher levels of inventories and that oil prices would remain low. So to better obtain a picture of what was happening, colleagues in our domestic economy department, and in particular staff from the bank's office here in Calgary, interviewed some of their contacts in the oil industry. And those discussions led us to conclude that market expectations were likely too optimistic. It was clear that the path to higher oil prices was not assured in the medium term, and that the negative real effects on capital spending were going to be larger than what was being captured in the data. So this would have a major impact on the economy. That knowledge fed into our judgment and ultimately our decision to lower interest rates in January and July of 2015. 2 years later, it is our view that these cuts have helped to facilitate the economy's adjustment to the oil price shock and that the economic drag from lower prices is largely behind us. We will be updating our outlook over the next few weeks and release it with our next monetary policy report on the 12th of July. Now, lastly, we've established a forum for gathering fixed income market intelligence. We wanted to better understand this shift in risk-taking that we were seeing and its impact on market functioning. And so around 2 years ago, we created the Canadian Fixed Income Forum, also known as CFIF. Its membership is composed of senior professionals from both buy and sell-side firms from across the country. I co-chair this committee, which meets quarterly, and its goal is to explore developments in the fixed income market by tapping into the collective expertise of its membership. And it includes looking at areas such as trading practices and changes in market infrastructure. The committee's efforts involve research and analysis to identify potential enhancements and to raise awareness of these issues. All of our meetings, presentations, and our minutes are available on the bank's website. So let me turn to what we're learning and how we use market intelligence. As the G20 financial system reforms were being put into place, there was a lot of concern by some market participants about how that could be affecting bond market liquidity. And so that's why one of the first initiatives that CFIF undertook was a survey of investors active in the Canadian fixed income markets. And we learned a great deal from this survey. Participants confirmed that most fixed income instruments had experienced a slight decline in market liquidity over the past 2 years. They also told us that liquidity for certain products, such as investment-grade corporate bonds, had deteriorated the most. One key takeaway was that many participants have adapted to this change in liquidity by adjusting how they manage their own portfolios. Now, those adjustments include taking more time to execute by breaking up their trades into smaller pieces, holding more on-the-run securities, holding less liquid assets for longer periods of time, and reducing the overall turnover of their portfolios. So these changes in strategy were particularly evident in the corporate bond space. So these survey results are providing CFIF with a foundation for further work in areas where improvements in market functions may be made. Discussions at our CFIF meetings are also inspiring new areas of research. Last year, members commented on the increased use of Canadian bond futures for hedging by the dealers. And so in analyzing the data, we noted an increased level of participation by high-frequency traders or HFTs in this space. So in response, we undertook a study of HFTs in the Government of Canada bond futures market. And we used data provided by the Montreal Exchange to understand the impact of HFTs on market functioning. And our analysis showed that their average effect on market pricing was slightly positive. Both effective and bid-ask spreads, as well as volatility, declined, while the depth of the market increased. HFT had a small beneficial impact on the all-in cost of execution for smaller trades. It was also clear from the data that many participants were now splitting their trades into smaller blocks, and that was something we were hearing both through CFIF and through some of our other discussions with market participants across a range of asset classes. So what's on our horizon these days? Well, as we outlined in the recent FSR, changes in mortgage rules late last year have led to important shifts in mortgage activity. Because of significant growth in house prices in some of Canada's largest cities, we've seen an important increase in the uninsured mortgage space. This has highlighted the potential need to develop additional sources of funding, particularly for the smaller lenders in this market. To diversify funding sources, one solution could be the development of a private mortgage securitization market, and this option has come up in several of our recent conversations. Now, we know if poorly structured, securitization markets can have significant vulnerabilities, but if appropriately developed, private label securitization could benefit the economy by helping lenders fund assets while broadening the available collateral to promote market functioning. Again, we will continue to develop and monitor this space. Another initiative at the bank that we're working on right now is a systemic risk survey that we will launch next year. We plan to conduct this survey biannually to seek views on key financial system risks and developments, as well as measure overall confidence in the Canadian financial system. We're finalizing the details, and we expect to launch this early in 2018, and the results will be published with our financial system review. So let me conclude. As a central bank, we rely heavily on our excellent models and incoming data for our forecasts. Yet we know that the intelligence that we gather is a critically important complement to them, particularly during times of transition or when sentiment is playing a bigger role. This information gives us a deeper understanding of how the economy is performing, how markets are functioning and evolving. And what we learn from all of this, our models, the data, our analysis and intelligence from our contacts, feeds into our judgment on our policy actions. I want to emphasize that although our policy judgments are guided in part by our intelligence gathering, we know that financial markets are dynamic and that we'll never have a complete, up-to-the-minute picture of all activity. We're realistic about this and are constantly learning and seeking to know more. So it's essential that we communicate regularly with participants across all dimensions, whether it be investors or issuers, the operators of financial market infrastructures, regulators, or other capital markets facilitators. And we share much of what we learn. While we're committed to transparency, we're also mindful of the need to respect the confidentiality of what we hear from individual firms. We publish our findings in the FSR and other bank publications and in CFIF minutes that are posted on our website to educate and raise awareness both domestically and internationally. So let's talk. Our ultimate goal is to promote a stable and resilient financial system that serves all market participants. We need and value your collaboration and feedback to do so. Thanks for listening.
Hi there, everybody. For those who don't know me, my name is Patrick Reed. I'm a director and co-chair of the programs committee this year for the CFA Society Calgary. First of all, thanks again for being with us. And before we jump into Q&A, I'd also just like to reiterate our gratitude to Ms. Patterson for being here with us today. Thank you again for joining us. So we do have about 15 minutes available for Q&A. So what I'd like to ask is, if you have a question, if you could just raise your hand. We're going to have a microphone at the back. And so Linus, who's got the microphone, he's going to walk around and one by one. If he'll bring the microphone to you, and if we could just ask you to speak into the microphone clearly, Lynn will be available for the next 15 minutes or so to answer your questions. So just to get us started, I've actually got one question that I'm going to ask, if I may, and then we'll begin to take questions from the audience. So, Lynn, my question is, clearly an important part of your role at the bank is monitoring activity in the formal banking sector. I'd be interested in your views on how concerned you are with risks outside the formal banking sector, and also what tools the bank has available to it to monitor activity in the more informal sector.
Okay. Thanks, Patrick. Good question. Okay, so we, with our financial system review, like to highlight and identify vulnerabilities and risks that we think are significant. I mean, obviously, you can have an endless list if you want to keep drilling down into different vulnerabilities. But we're really looking for concerns that would be systemic in nature across Canada. And so part of this broadening market intelligence team is really to spend more time on sectors that may not be as regulated. And so in our financial system review over the past few years, we've written some reports on the shadow banking sector, and we're continuing to monitor different elements of that. We've written reports on mortgage finance companies and their role. And so we'll continue to identify what might be outside of the regulatory perimeter and then try to educate and raise awareness. In some cases, we're talking to other regulators to highlight some issues that we may or may not see, but it's an ongoing process, very iterative, and it's going to keep changing, I think. So that's why, you know, broadening the reach and speaking to people in all different facets across the market is really key. Thank you.
Artificial intelligence is getting a foothold in different parts of our economy.
Yeah.
What are the risks you see as artificial intelligence plays a larger role in the financial sector, and risks and opportunities?
Right. Well, it's true that there are many things that are changing right now. Artificial intelligence is obviously one that people have to keep a close eye on. We actually, in this latest financial system review, focused on cyber risks and the importance of cyber resilience across Canada. And so, you know, I think like many of these things, it's really hard to kind of wrap your hands around because you're not sure. There's pros and minuses, so I can't really say too much about what the direction might be as far as concerns. I think from a central bank perspective, you know, we're trying to keep apprised of as many of these developments and the implications that it has for the economy. And that's kind of the purview that I can take on that question. But, you know, the dynamics in this space are continuing to accelerate, it appears, and so we'll be watching closely.
I have two questions, so if you don't grab the mic away, I'll ask both. First one, does the Bank of Canada explicitly consider how its decisions might impact Canadian equity markets? And, which is not second question, second part of first question, does the Bank of Canada take into account global equity markets implicitly or explicitly in its decision making?
Yeah. We do. Yes, yes, and yes, but let me give you a bit more detail. So, you know, we think about global financial conditions and we think about financial conditions in Canada. And so certainly one of the inputs would be what's happening in equity markets. And we do think about the implications for equity markets if we're at a juncture in our policy decision making where we might be making a change. So it is part of our inputs, and globally as well. It's important for us to look at how equity markets are behaving. And so, you know, it's not a barometer that we would use as specifically as we do, obviously, the policy rate or short-term interest rates, because we know that's our most efficient transmission mechanism, but it's certainly an input in our models.
Thank you.
Yeah.
And then the second question, it sounds to me like as the Bank of Canada increased its interaction with players within the Canadian industry, it sounds like you were looking for sort of more qualitative commentary or input than maybe models typically give. Could you maybe just give a comment on the Bank of Canada's views of the value of qualitative versus quantitative data, and if that's evolved at all or where you see that going?
Yeah, it's absolutely critical that we can mesh the two, and that's really what's so important about our outreach across not just the Business Outlook Survey folks, but when we meet with people. And, you know, as I mentioned in this speech, often the data is telling us something, but, you know, we have lags in the data, and so you want to kind of get more of a real-time pulse of what's happening, or the data may be giving you obviously a point in time measurement, but there's much more of a rich dialogue around that discussion. So I think we are appreciating the significance of being able to reach out to a whole myriad types of players on a regular basis. And, the Business Outlook Survey is a very good example of that, where I think it tries to, in a data form, bring some confidence and sentiment measures to how people are feeling. So you can, in fact, look at something, a certain variable on a quarter-to-quarter basis and see how it's trending. So yes, it's a critical input, and I think, we think it's invaluable to sitting down and putting everything together that's in front of us, and then ultimately using our judgment to make a policy decision.
I found your talk very interesting on how the role of the Bank of Canada is expanding into various areas that you're delving into. However, there have been many articles written where not only the Bank of Canada but other central banks around the world are becoming toothless taggers with really no tools to change economies or markets as they had in the past many decades ago. In Canada, we didn't use quantitative easing. There are those who believe it is working. There are those who believe it was just a very big expense and didn't really work. Although we didn't use that in Canada. So I'm most interested in getting your perspective because I'm sure you've read all the articles and you have the inside scoop on the effectiveness of the Bank of Canada, or at least your perceived effectiveness. We've seen banks not lower their prime rates as the bank has lowered their bank rate. So they're putting their feet in the sand and saying, no more, no more. Mm-hmm. So with these things happening in the world, and with your inside perspective, can you fill us all in on how strong do you really feel?
So what I will say is that, it's been interesting globally to watch the various tools that have been used. And, the governor outlined, I'll probably get the date wrong, but I think it was late in 2015, what our toolkit looks like. And at the time, he talked about being in that toolkit, the ability to use a number of what would be unconventional tools, such as negative interest rates or quantitative easing. So I'm not going to judge or give any comments on what other central banks have done and how effective they've been. I think in some cases we just don't know yet. It's a bit too early. I would say, and this may be relevant to this crowd, but I think we feel that our transmission mechanism or our ability to affect change has been working quite well, and that the 2 interest rate cuts that were delivered in 2015 has helped the economy transition and adjust to a different base, but to a base where we're now seeing growth broaden across a number of different industries. We've seen labor mobility that's had to occur as a result of that. So those interest rate cuts actually help to facilitate that adjustment in the economy that was needed.
Oh, just
Sorry.
I also hit the mic just to take
Sorry.
advantage. To that point, though, of what the interest rate cuts did and the motivation behind the technique to try and increase inflation from that, but that deflationary forces are starting to more outpace, I think, monetary policy in the sense of you have a lot of technological improvements so that when previously low interest rates meant the company would go and build a new factory, that meant thousands of jobs for new workers for the factory. But now the monetary policy goes to buying one analyst to write a piece of code, and then that has much more production impact because of that. Is a 2% inflationary target still realistic? And how worried are you about these continuing to face deflationary factors because of we already have a lot of stuff and we don't need to build as much stuff as we used to? And that also that with the quantitative easing, most of it's gone to propping up financial markets as opposed to economic development.
Right. So we just renewed our 5-year inflation targeting agreement with the federal government and committed to the 2% target for the next 5 years. And there was a tremendous amount of research that was done around that, and everything's on the website. It's quite interesting because we did, consider different alternatives, and I think we're actually one of a few central banks globally that have a regular review of that process to kind of validate. With respect to your comments on disinflation, I mean, certainly recently we've seen some inflation below our 2% target. In April, which was our last monetary policy report, we had expected to continue to see a little bit of that until later this year. And at that point, driven by changes primarily due to food prices and some competition that we're seeing in that sector. It's interesting, even in the last data that we got last week, I mean, you are seeing quite a differentiation between services inflation and goods inflation. So I think globally, the inflation picture remains something that everyone's analyzing and spending a lot of time on. We're going to be updating our forecast for inflation when we update our economic forecast in the next couple of weeks. So I don't have too much to say in advance of that. But at this point in time, our primary mandate is to continue to reach that 2% inflation target, and it will be for the next 5 years.
I'll just say thank you all for the great questions so far. We are running a bit short of time, so we probably have time for one more question. So let's do the last one.
Thanks. There's the cool, calm, and collected attitude that you reflect of the bank is quite interesting when we have really one major wild card that you don't mention at all, which is our neighbors to the south, and what's happening there in light of the current president. Soon he'll be there for quite a while yet. And what are we seeing about that? Are we just guessing? Is that the big fudge factor, the plus or minus 10 or 25%? What could be happening?
So how we are trying to deal with what's happening with our southern neighbor at this point, kind of falls into this realm of uncertainty. And we think that it's manifesting itself primarily in the business investment numbers. And rightly so. I think we heard in the last Business Outlook survey that was out in April that, many goods producing firms were hitting capacity constraints, but, they were unwilling to really do any new major investments until they have more clarity. So, I think at this point we've seen some initial actions. We now have a timeline that's at least been suggested for the NAFTA to begin later this summer. And so, we don't take anything on until it actually happens. In our April monetary policy report, at the back of every monetary policy report, we have a risk section. So at the top of that risk section, we basically said, really hard to quantify this, but we know that it's having some uncertainty impact. We have applied a little bit of judgment on both our outlook for business investment and exports to reflect that. But for the most part, we'll be waiting like everyone else to see where things land. Thank you all very much. Have a great day.
Thanks again, everybody, for coming. On behalf of the